Canadian REITs are an excellent way to get into Canadian real estate without having to deal with property problems and needing third parties like real estate agents, lawyers, and lenders. In Canada, 90% of all REITs are already listed on the stock market, and an interesting fact is that they collectively control 1/3 of the retail shopping center space in the country. So without further ado, going from the smallest to largest for the top 10 biggest Canadian REITs and then the 3 big REIT ETFs. First Capital REIT. First Capital is an owner and operator of mixed-use retail properties in Canada. It IPO'd in 1994, and it was an early interest by RioCan back in 2000. But ultimately, First Capital was acquired by the real estate company called Gazette, whose ownership was reduced to 6.7% over the last 20 years. Currently, First Capital's real estate portfolio totals around 23 million square feet of leasable space across Canada. Its rent income distribution is like this, with around 73% coming from Ontario and Alberta. For future developments, First Capital is looking to double its square footage with new residential and commercial properties mostly in Toronto. As of today, the company is $3.3 billion in size. Dividend yield is 5.9% with payments on a monthly basis, and the dividend growth since it started in 2014 has been unchanged at 0%. In terms of its real estate portfolio, First Capital is valued around $142 per square foot. It's simply the market size of the company divided by the total real estate space it owns. Just for reference, new downtown Toronto condos are valued at $1,000 per square foot, but when excluding the mortgage, then it's like buying at $200 per square foot when using a 20% down payment. A $10,000 investment in First Capital with dividends reinvested in the last decade would have generated $7,600 in dividends and an end investment value of $14,700. That's an ROI of 47% and an annualized growth of 3.9%. CT-REIT. CT-REIT stands for Canadian Tire REIT, where Canadian Tire owns stores, which include Sport Chek and Marks, are its biggest tenants and represent around 92% of the rent it receives. The REIT started in 2013 when Canadian Tire spun off all its real estate. Currently, its real estate portfolio has around 27 million square feet of leasable space across Canada, and its income distribution is like this, where 65% come from Ontario and Quebec. Future development plans by the REIT include adding another 1 million in square feet to the portfolio across Canada over the next few years. As of today, the company is $3.2 billion in size, dividend yield is 5.7% with payments on a monthly basis, and the dividend growth since it started in 2013 has been around 2.8% per year. In terms of its entire leasable real estate portfolio, CT-REIT is valued at around $119 per square foot. A $10,000 investment with dividends reinvested in the last decade, or 2014, would have generated $5,200 in dividends and an end investment value of $17,900. That's a return on investment of 79% and an annualized growth of 9.3%. H&R REIT. H&R REIT is an owner of office, retail, residential, and industrial real estate in North America. For everyone wondering, there's no affiliation with H&R Block. The REIT started in 1994, and its portfolio currently has around 41 million square feet of leasable space. For rental income, it's divided between Canada and the US like this. And within Canada is divided like this, with Ontario and Alberta making 88% of rent. Among its real estate categories, the income is mostly generated from its office and retail properties, which combined make up 85% of its rent. For future development, H&R is looking to add approximately 8 million square feet of mixed-use residential and industrial real estate in Canada and the US. As of today, the company is $2.8 billion in size. The dividend yield, after reflecting its recently huge haircut, is 7.1% with payments on a monthly basis, and the dividend growth in the last decade has been around 1%. Prior to the cut, the dividend growth was actually 8.3%. In terms of its entire leasable real estate portfolio, H&R is valued at around $71 per square foot. A $10,000 investment with dividends reinvested in the last decade would have generated $9,800 in dividends and an end investment value of $10,100. That's a return on investment of 1% and an annualized growth of 0.1%. The reason why the end value is almost equal to the dividends is because there's been a lot of dividends reinvested at higher share prices, which are technically losses at today's stock market price. Smart REIT. Smart Center specializes in retail and mixed-use properties, where a majority of their malls have Walmart as their anchor tenant. Walmart Canada represents roughly 25% of the rent it receives, and Winners and Canadian Tire brands are around 5% each. The REIT was founded in 1994 as First Pro Shopping Centers, and it was renamed to Smart Centers REIT in 2015 after being acquired by Callaway REIT. Billionaire Michar Goldar, who is the founder of Smart Centers, is the largest shareholder with a 9.7% ownership. Currently, the real estate portfolio has 34 million square feet of leasable space with rental income divided in Canada like this. Ontario generates 63% of the rent. For future developments, Smart Centres is looking to add 28 million square feet of mixed-use retail and residential real estate. As of today, the company is $3.5 billion in size, dividend yield is 8.9% with payments on a monthly basis, and the dividend growth in the last decade has been around 1.8% per year. In terms of its entire leasable real estate portfolio, the REIT is valued at around $102 per square foot. A $10,000 investment with dividends reinvested in the last decade would have generated $6,400 in dividends and an end investment value of $18,600. That's a return on investment of 86% and an annualized growth of 6.4%. Granite REIT. Granite owns logistics, warehouse, and industrial properties in North America and Europe. Magna, which is Canada's largest auto parts manufacturer, is its largest tenant, making up 42% of the rent it generates, and then it also has Amazon, who represents 8% of the rent. Founded in 2012, Granite was originally called MI Developments, which was an original spin-off from Magna and was indirectly controlled by the billionaire founder of Magna, Frank Stronach. Frank gave up control by 2011 in exchange for some of the bankrupt entertainment assets that Granite held from the past. Currently, Granite's portfolio has around 40 million square feet of leasable space with income divided like this, where 88% is made in Europe and the US. For future developments, Granite is looking to add an additional 2.2 million square feet in distribution and warehouse facilities. As of today, the company is $3.9 billion in size, dividend yield is 4.4% with payments on a monthly basis, and dividend growth in the last decade, or 2013, has been around 5.1% per year. In terms of its entire leasable real estate portfolio, Granite is valued at $98 per square foot. A $10,000 investment with dividends reinvested in the last decade would have generated $21,400 in dividends and an end investment value of $83,100. That's a return on investment of 731% and an annualized growth of 23.4% per year. Choice Properties REIT. Choice Properties primarily owns retail properties anchored by its major tenant, Loblaws, who represents 56% of rental revenue. The REIT was founded in 2013 after Loblaws spun off its real estate. Originally, Loblaws was the majority owner of the REIT, but in 2018, a transaction occurred where George Weston became 65% owner. Also in 2018, Choice Properties went out to acquire Canadian REIT, or CREIT for short, for $3.9 billion to make moves into industrial and office real estate. Currently, Choice Properties' portfolio has around 66 million square feet of leasable space, with income within its real estate categories divided like this, where retail is still the huge majority. For future development, Choice Properties is looking to add an estimate of 3 million square feet of retail and residential real estate projects. As of today, the company is $4 billion in size, dividend yield is 5.5% with payments on a monthly basis, and the dividend growth in the last decade, or 2013, has been 1.8% per year. In terms of its entire leasable real estate portfolio today, Choice Properties is valued at $61 per square foot. A $10,000 investment with dividends reinvestment in the last decade, or 2013, would have generated $5,800 in dividends and an end investment value of $18,600. That's a return on investment of 86% and an annualized growth of 11.8%. RioCan, which stands for Retail, Industrial, Office, Canadian, primarily owns grocery-anchored retail centers and mixed-use developments located in Canada. The REIT was founded in 1993 and was originally called Council REIT before being restructured and getting the name change. It originally had US real estate, which was worth almost 20% of its rental income, before it sold it to Blackstone in 2015. In the same year, RioCan decided to shift its strategy to focus on residential real estate due to the threat of e-commerce. Currently, RioCan's portfolio has around 31 million square feet of leasable space, with income practically at 100% retail. For future development, they're looking to add almost 15 million square feet of mixed-use residential real estate. As of today, the company is $4.8 billion in size, dividend yield is 9% with payments on a monthly basis, and the dividend growth in the last decade has been around 2% per year. In terms of its entire leasable real estate portfolio, RioCan is valued at around $155 per square foot. A $10,000 investment with dividends reinvested in the last decade would have generated $9,800 in dividends and an end investment value of $13,200. That's a return on investment of 32% and an annualized growth of 2.8%. Allied Properties. Founded in 2002, Allied Properties specializes in developing and owning premium office real estate and data centers in Canada. They're focused on creating Class 1 workspace, which is a format that reuses light industrial structures. Currently, Allied's real estate portfolio is more than 14 million square feet of leasable space with income distribution across Canada like this, where Ontario and Quebec make up 87% of rent. Amongst its real estate categories, it's like this, with office representing 70% of rent. For future development, Allied Properties is looking to add almost 2 million square feet of office, retail, and residential real estate in Toronto, Calgary, and Montreal. As of today, the company is $4.9 billion in size, dividend yield is 4.2% with payments on a monthly basis, and the dividend growth in the last decade, or 2012, has been 2.3% per year. In terms of its entire leasable real estate portfolio, Allied is valued at $342 per square foot. A $10,000 investment with dividends reinvestment since 2012 would have generated $8,700 in dividends and an end investment value of $29,100. That's a return on investment of 191% and an annualized growth of 11.2%. Canadian Apartments. Founded in 1997, Canadian Apartments, or CAP-REIT for short, is an owner of residential properties in Canada, Netherlands, and Ireland. In terms of portfolio, it manages over 62,000 units, and its rental revenues are generated like this, where Ontario and Quebec represent 68% of rent. For future development, CAP-REIT is looking to add approximately 8,800 suites in major Canadian cities. As of today, the company is $8 billion in size, dividend yield is 2.8% with payments on a monthly basis, and the dividend growth in the last decade has been around 2.5% per year. In terms of its entire leasable real estate portfolio, the REIT is valued around $124,000 per unit. For reference, the median Toronto home price is around $737,000. And using a 20% down payment means that a person typically buys at $147,000 per unit. But in terms of its leasable area, assuming the average apartment in Canada is 850 square feet, then CAP-REIT's portfolio is estimated to be 53 million square feet, meaning its portfolio is valued at $151 per square feet. A $10,000 investment with dividends reinvested in the last decade would have generated roughly $11,000 in dividends and an end investment value of $50,800. That's a return on investment of 408% and an annualized growth of 17.5%. Brookfield Property Partners. Founded in 2013, Brookfield Properties owns one of the world's largest portfolios of office and retail real estate, and it also engages in value-added investments in residential and industrial real estate. The parent company, Brookfield Asset Management, owns 51% of the REIT. Currently, the portfolio has around 213 million square feet of leasable space, and its income is generated in geographies like this, where US makes up 72% of the rent. Amongst its real estate categories is divided like this, where every category has a solid amount of focus. For future development, Brookfield is looking to add 12 million square feet in mostly office and residential real estate, and it's redeveloping parts of its retail. As of today, the company is $13.2 billion in size, dividend yield is 12.2% with payments on a quarterly basis, and the dividend growth in the last decade, or 2013, has been around 4.1% per year. In terms of its core leasable real estate portfolio, Brookfield is valued around $62 per square foot. A $10,000 investment with dividends reinvested in the last decade, or 2013, would have generated $4,700 in dividends and an end investment value of $9,100. That's a return on investment of -9% and an annualized growth of -1.3%. BMO's Equal Weighted REIT Index ETF. With this ETF, you get an equally weighted portfolio of the largest Canadian REITs. But when looking at the top 10 holdings on the left, occasionally the weights shift out of equality due to daily fluctuations, but they're rebalanced every quarter. When you look at the categories of the entire portfolio on the right, it ends up being very concentrated in residential, retail, and industrial real estate. A $10,000 investment with dividends reinvested in the last decade would have generated $8,600 in dividends and an end investment value of $20,700. That's a return on investment of 107% and an annualized growth of 7.6%. Ishares S&P/TSX Capped REIT Index ETF. With this ETF, you get the largest Canadian REITs, but the individual weights of each company are more represented by their actual market size. This is basically implying that the bigger the company, the more concentrated they are in the portfolio. So in this case, Canadian Apartments, which is the biggest weight in the ETF, is more than double the size of many of the other top holdings. Unfortunately, the weights are not allowed to exceed 25%. Another thing to notice is that the top 3 holdings out of the top 10 already account for 40% of the ETF. When looking at the categories, it's very similar to the previous ETF, but there's more retail and less industrial and healthcare real estate. A $10,000 investment with dividends reinvested in the last decade would have generated $8,700 in dividends and an end investment value of $19,800. That's a return on investment of 98% and an annualized growth of 7%. Vanguard FTSE Canadian Capped REIT Index ETF. With this ETF, you get everything directly related to real estate in Canada. That includes companies that don't own any real estate and only focuses on services and development for the industry. Like the previous ETF, the companies are more represented by their actual market size, and the bigger they are, the heavier their weight in the portfolio. The top 3 holdings, which again are the same, account for almost 40% of the portfolio. Interestingly, the non-real estate owning companies in the portfolio represent around 22% of the weight. A $10,000 investment with dividends reinvested in the last decade, or 2013, would have generated $3,400 in dividends and an end investment value of $13,200. That's a return on investment of 32% and an annualized growth of 3.8%. So here's a summary of all the investment data for the top 10 biggest Canadian REITs and the big 3 ETFs. You'll notice that the popularity of REITs and ETFs have only started in the last 10 to 20 years, and most of them are at the $3 to $4 billion market cap size. On a dollar per square foot basis, every REIT is pretty cheap to own relative to buying property yourself in Toronto, with the exception of Allied Properties. Dividend yield is pretty attractive at around 6 to 7% on average, but dividend growth is only 2%, which is only covering inflation. Interestingly, the ETFs don't have a consistent dollar amount of dividends that they pay out every month, so the amount that you receive today could be higher or lower next month. In terms of return on investment, you'll find that the top 10 REITs on average outperform the ETFs, and some specific ones have done so much better. But if you don't want to pick and choose, then sticking with the ETFs would be okay performance. Here's a high-level summary of the developments going on for the big Canadian REITs. I find that this is important to know because the big Canadian REITs have a big influence on the places that we shop, work, and live at, and how the Canadian real estate landscape is changing in the future. Some REITs have a lot of developments in the future that pretty much changes the description of their real estate portfolio. Particularly, First Capital, Smart REIT, and RioCan are the ones looking at the biggest projects changing their entire portfolio base. The big observation with all the REIT developments going on is that they're mainly in retail and residential real estate. But lately, the developments are really the mix of two, where you have retail at the bottom floors and residential at the upper floors. Interestingly, there's not as much interest in office development. When you add together the square footage of all future developments by the Canadian REITs, the existing real estate base is expected to expand by 20% in the future. So basically, I'm saying that expect 20% more real estate for shopping and apartment units in the near future. So that's all for now. If you made it through this video, I hope you learned a lot about Canadian real estate. If you enjoyed this video, remember to click the like button and subscribe to my channel if you haven't already. Let me know in the comments below what your thoughts are on the Canadian REITs or which ones you're investing in.